This is our Forex currency blog for February 3rd, 2011. If you've been watching past ones, you'll see something different. One of the things that we usually start the day looking at is our currency meter. You want to find strong currencies both in real time, which is on the top. Underneath that, we now have the weekly, monthly, daily, weekly, and monthly trend. This is using the same technology that we have on our charts, and I've made it work with the individual synthetic pairs. This is a dollar by itself. I compare all the dollar pairs to see whether it's going up or down on real-time basis, which is very fast, daily basis, weekly basis, and monthly basis. So obviously, if you have a very weak currency like the dollar and a little bit less the yen, or if you see real-time incredible weakness in the euro and incredible strength in the Australian, this one had incredible real-time strength. Daily, weekly, monthly makes it one of the strongest. Also the pound from 1 to 5 today. You want to sell the weak one against the strong one. Weak euro, strong Australian. Let's bring that chart up just to give you an idea. And you can see it broke down underneath the previous day's low, fell about 75 pips right there. You might have looked for some pullback trades right here at the previous week's low. Get short again here, and this sideways. Anytime you see a half-hour to 2-hour sideways range breakdown, and this one led to about led to a 75 pip move, and usually you never want to sell underneath the lower containment band. So I'll be honest, I probably wouldn't have taken this trade right here. We're creating some new scalping tools that will measure the statistical strength and weakness on a tick by tick basis. To give you an idea, are all of the euro dollar pairs falling in real time? If you shorted this right here, you'd want all the euro pairs getting weak and the Australian pairs going up, and that would keep you in a riskier trade like that, which in this case pulled back about 40 pips. The pound also, like I said, was very strong from about midnight till 5. The dollar, the daily, weekly, monthly trends down. There wasn't a whole lot of strength, not intense weakness, but a super strong currency will go up even against a slightly less strong currency, and definitely one that's as weak as the dollar is right now. So from midnight to 5, you had some great trades in the pound dollar. Here's midnight, the price is underneath the hourly, so you got to be a little bit careful. It breaks back above here, you go long. You might have got out of a trade right here when it went sideways. Here was the previous swing high. When it breaks out, you go long, and you got these resistance areas up here where you want to look to get out of the trade. You made about 50 pips on there. This is perfect example of our Elliott two-wave pullback system. You draw your fibs on the first wave, you look to get in at the second pullback area, and you get in, the market kind of goes sideways. You're trading in the direction of the trend. Here's my Fibonacci profit target levels that I've spent about 40 to 45 minutes every night drawing. And because the pound's been up so many days in a row, there's very high probability maximum profit. You get into this trade either on this pullback right here, or when it breaks out of the sideways range right here, and it just explodes up. You probably would have got out of this trade somewhere up here at 71, making 50 pips on that trade. Now you might have got into a pullback here, hoping it finds some support, and that would have been a losing trade. Usually when it pullbacks to the hourly right here, that's a decent place to get in. If you bought this little double bottom right here at 01, it went all the way up to 17. So our rules are, once it moves up 5 or 6 pips, we cut our stop in half. So you'd have about a 5 pip stop. Once it moves 10 pips, you move your stop to break even. And if you're watching the charts in real time on a tick chart, more than likely you made 4 to 8 pips on that trade. Because the pound's been up so many days in a row, when it finally breaks down underneath this hourly again, after making one more wave up today, decent place to go short. Usually it'll work its way down to the lower containment band. The currencies that are up too much, so that's a very excellent. Maybe you're short here at 90, out of the trade here at 41. Another 50 pip move, and you can see the strength that was there before at 5 turned into weakness. And you got to know your currencies. If a currency's up 3, 4, 5, 6 days in a row, it's likely to pull back. The Swiss today also very, very weak. The daily and weekly trend were down. The monthly trend shifted down at 4:30, along with incredible real-time weakness. Earlier in the day, you could have bought the strong pound, weak Swiss. Let's show that chart. Pound Swiss, and guess what? It went up. It's above the hourly, kind of consolidating here. Breaks out. You might go long with these as your profit target levels, and it shot right above it. We use profit targets to estimate whether a trade's worth taking or not. If you're going to risk 10 pips or 15 pips, you need 1.5 to 2 times bigger profit target to make it worth taking. Now, sometimes your profit targets don't get hit, and you either have a loss, break even, or you make less profit than you anticipate. Other times, like this, the market shoots through these resistance areas, and especially at the upper containment bands, very likely to kind of stall and come back. That's why it's always risky to buy above the upper containment band. And so you're out of your trade somewhere. You know, you might have went long right here at 31, out of this trade somewhere up here at the whole number. It's a 70 pip move. I would have, because this is so strong and all the time frame trends are lining up on a tick-based chart, I would have bought this little pullback right here, somewhere maybe around 75. It went up 15 pips, which is more than enough to move your stop to break even. I probably would have snagged 4 or 5 pips out of that. Because, you know, if they're going up and I see weakness down here, I'm going to get out. Pulled back again, found support here, broke out. Obviously, this was probably a news-related breakout. You're in at 72, and our trading zones are very high probability places to get out of the trade. Plus, you draw your fibs on the last wave. Notice it went to the pip, to the 1.382 Fibonacci profit target. Anytime fib levels or any resistance levels are hit beyond the upper containment band, don't be greedy, exit your whole trade. That was a phenomenal trade, in at 74, out at 60. You know, about an 80 plus pip move. And you might have also bought this little pullback right here, probably lost 5 or 10 pips on it, bought it. This one right here maybe made 25. But excellent use of the currency meter. Strong pound, weak Swiss, both, you know. Now that we have the daily statistical trend on here, you can quickly look at the chart, and at 2 o'clock, the daily weakness at this was weaker than the dollar. It was about as weak as the yen. You know, the pound yen very likely during that time was going to explode up too, and it did. You can see that explosion. You might have got into a trade here and lost. You got in here and you made a lot of money too. You know, but other than the yen at that particular time and the New Zealand, the Swiss was also extremely weak and had incredible real-time weakness. You could have also bought the strong pound versus the weak New Zealand. The daily, weekly, and monthly trend on this are very weak. You're very likely to make money by looking to buy breakouts in the pound New Zealand. Let's take a look at that one. Not many of us trade this too often. And now this one, you know, the only downside of this is it's already above the upper containment band. And this is one of the reasons why, you know, you got to be really cautious in buying at or above the upper containment band, because usually price, you know, goes a little bit and comes back. Your chance of getting a huge win is very low, 30% at the max. You probably are 50-50 from the trade, even giving you 10 or 15 pips profit versus, you know, losing that much. But this market went sideways for a while and broke out. You might have gotten into this trade at 70. It went up, you know, 40 pips. That's actually pretty decent. The chart's scaling is, you know, hard to tell how big a move these are. These are actually pretty decent sized moves. You're in this trade here, maybe you're out. Anytime it kind of runs out of steam or you don't have incredible momentum, you know, get out of the trade. Maybe you decide to buy this pullback here, made 5 or 10 pips. And anytime you see the market chop around sideways, finds a support area, breaks out, maybe you went long right here at 86. This last wave up, you draw your fibs. Anytime it's above the upper containment band, don't get greedy. Either get out at the first or second fib target. In this case, it shot through the first one, went to the second, started to come back down. I might have got out of this trade here around 65. We're long here at, let's just round up to 85. You made 80 pips on that trade. And again, incredible momentum on the way up. Using our currency meter to just basically buy the strongest pairs, pound, Australian. You know, let's look at the Australian New Zealand. Super strong Australian, very, very weak New Zealand. It doesn't take a rocket scientist to know that most times this currency is going to go up. Now again, this is dangerous territory up here because it's already above the upper containment band. It's best when you start to find a trend earlier in the move where it shows incredible strength and it's not above the upper containment band. So I would have totally avoided this one because it was, you know, above it. The pound New Zealand pretty much at least pulled back inside the range many times, giving you, you know, or it was right near it. You know, much different scenario in this case. I wouldn't have taken any Australian New Zealand trades because the odds just weren't there. Let's take a look at other areas. These fib levels are likely to be support. Anytime they get broken, the market's very likely to fall and go lower. Obviously, this was a news report at 8:30 that caused the euro dollar to break down. It was potentially likely to stall here, and if it breaks through there here, This one was so weak, and the real-time momentum showed that it just continued. So just trail your stop down if you catch these type of moves. Fib levels that get broken tend to cause some explosive moves. This one was news related, obviously. Fib levels up here nailed the high. This level here acted as a resistance area, then it went to the next fib level, which any kind of fib or resistance area is above the upper containment band, it's very likely to reverse there. In this case, the weekly and monthly trend, the weekly trend was down, it just barely shifted up here. Monthly trend was down. Great short in the dollar Swiss up there. Plus the previous swing up move, if you drew your fib from here to here, we have the fib target right there, the 1.618, right at the monthly pivot. The longer term trend's down in this, as we all know. So when they do make counter trend moves up that are too strong, and look at the momentum, it's not at or above our 20 extreme level. It was pretty decent earlier, and as it's making a higher high, you actually have less momentum. Anytime you see that with a currency where there's longer term trends down, it's a pretty high probability trade. Most of the time it will work its way back over 30 minutes to 3 hours to the hourly moving average down here around 30. So you might have shorted this up here at 10, made 80 pips on the counter trend move. No trading zones on that one. Here's a narrow range pattern. Sometimes when you see these narrow range patterns and you have an hourly narrow range pattern right at a support level, the daily, weekly, monthly trends up. We already showed you how strong the Australian was. This is a pretty high probability trade right here. And you can see it just shot right up. The IntelliTrend bars were green even before it broke out, and it just went up to this resistance here and kind of ran out of steam. You might have also bought this little pullback here because of the extreme strength, but earlier today the Australian was very strong. Now, the New Zealand was very weak. This fib level here acted as support. Last night you might have gone short here, made a little bit, shorted here, made a little bit, but it's not a good idea to short right in front of a likely buy area. Unless you see incredible weakness right, shortly before. This market's kind of going down with very little momentum. Now also sometimes you have the dollar that's weak and the New Zealand that's weak. If the dollar is weaker than the New Zealand, or I should say the New Zealand less weak than the dollar, you'll have a weekly monthly trend that's up, even though neither of those is really strong against other pairs. So that's something you have to. That's why it's always best to look at the currency meter and spot each one's. This one's weak and this one's weak. You're much better off trading a weak one against a strong one like this or this. I already showed you those charts. Those charts, led to trades that were very profitable. Use the currency meter, both in real time and the daily, weekly, and monthly trends to line up trades. This fib level here, support, and once broken, this market's very likely to go down. This was your first profit target. Here's your second one, or another fib levels down here. Usually when it's this far underneath the lower band, I would have got out of the trade somewhere down here, maybe around 70, 72, short around 30. So that's a 60 pip move. I probably would not have shorted this way down here, but one of the tools I plan on creating is going to use super ultra fast tick data to watch the tick by tick movements of all the euro pairs in real time and the yen pairs. So if you do see this kind of incredible weakness and you really think it's going to go down and you short it, hopefully soon within the next 2 weeks we'll have a tick based chart. You may have to update your machine to 8 gigs of memory. This thing is going to use massive amounts of memory. It probably will not run on 90% of people's machines, and I'm going to let you know that. In order to create powerful tools, sometimes we have to load massive amount of data and use statistical comparisons on it. You might need to buy a new machine to use that. And I'm not going to waste time, with tech support. You can just, if you want to use that new tool coming out, you probably have to buy a new machine or at least get 8 gigs of memory. It's not going to use much CPU power, so if you have a fast machine, you'll be all right. But it's very likely to use absolutely massive amount of data because every single chart is going to have tick data on 13 pairs at the same time. And they're just huge. So it may only work for 5 or 10% of us. Matt and I are going to use it and call out trades in class based on it. So if you wonder why we're so accurate, and some of these trades are going to be 3 and 5 pips. Matt and I woke up last night and traded. I actually took my first trade that Matt called out and got 6 pips from it. It was just kind of dead when we were trading at 6. And then another trade I took, I got in a little bit late, only made 2 pips on it, but pretty decent.